Hello, welcome to Any Answers Answered for February 2019. Hopefully all those tax returns now behind us and we can focus on some new questions and answers to look at. Our first question this particular month comes from Blackadder. And Blackadder asked a question about the permanent workplace rules, an old favourite. He has been asked to look at the expenses policy of the company he works for, and he thinks some staff may have fallen foul of the 40% rule. They have 2 offices. Each person is assigned a base office, and any travel to the other office is reclaimable. However, he's now realised that some people seem to work on a permanent basis, 3 days in one office, 2 days in the other, and they're still claiming their travel costs to the 2-day-a-week venue. His question is 2 parts. Am I correct, basically? But then also, who would be responsible for the problems created? So let's start with, is he correct, first of all?
Well, the question of whether a workplace is permanent or temporary crops up quite frequently, and it's quite easy to misunderstand the difference. The starting point for deciding whether or not travel and subsistence expenses are deductible is to ask whether the workplace is permanent or not. If it is permanent, then home to work travel, as we all know, whether you're self-employed or an employee, not deductible. If it's temporary, then it might be possible to get tax relief. Now, the legislation defines for employees, and let's now focus just on employees, that there are 2 types of workplace. A permanent workplace is one that the employee regularly attends in the performance of the duties of the employment and is not a temporary one. And it then says a temporary workplace is one that the employee regularly attends in the performance of the duties, well, that sounds the same as permanent, but it goes on, to perform a task of limited duration or for some other temporary purpose. Now, where you're looking at somebody who works 3 days a week in one office and 2 days a week in another, it sounds as though they do have 2 permanent workplaces, because in neither of those are they attending in the performance of duties to perform a task of limited duration or for some other temporary purpose. And it might be possible to argue that, but it's unlikely. But let me just say that we then have to read further. A place is not treated as temporary if the employee's attendance is during continuous work at that place lasting for more than 24 months, or the period for which the employee is likely to hold the employment or most of it. Now, that's the well-known 24 months rule. I say well-known, it's still quite often misconstrued, and you could take on an employee for a limited duration contract of, let's say, 9 months, well under the 24 months, but for the whole of that 9 months, they're working at a permanent workplace. So we don't simply assume that just because you're working somewhere for less than 24 months, it's a temporary workplace.
But if I was employed in the northeast of England and I had been asked to go to London and dig a tunnel across London for Crossrail, and my project was going to take 9 months, if my employer is still in the northeast, that's still where my permanent workplace is, that would meet the 24-month rule.
Well, I wouldn't say that's still where your permanent workplace is. You might not have a permanent workplace, but the 9 months contract or the 9 months work that you're doing in London likely sounds to be a temporary workplace in that scenario.
But if I was given a job by somebody in the northeast who said, your job will last for 9 months, turn up in London and dig this tunnel and then your employment will cease.
That's a permanent workplace.
That is a permanent workplace. But the revenue has a second wording, doesn't it, which is to do with this 40% of the time.
That, I think, is what's behind this question, the 40%. And of course, 40% of a 5-day working week is 2 days. So it's tempting to argue that if you're working 2 days a week in one place and 3 days a week in another, the travel expenses for the 2 days a week work will be allowable. But that's not the case either, because, as I say, the first question is it a permanent workplace? Now, only if you can argue that what you're doing at the 2 days a week location is for a temporary purpose, could you then argue that's a temporary workplace? So, and the same would apply even if it was 1 day a week. So we shouldn't assume that just because you're within the revenues rule of thumb of 40%, you're entitled to an expense deduction.
Because the 24-month rule is in legislation, is that correct?
Correct.
Where the 40% isn't.
Correct.
Okay, and the idea that they are separate rules, the idea that for the rest of my life I could do 39% of my work in a particular place, that would still be viewed as a permanent workplace.
Exactly. It's very unlikely that the attendance at that 39% location is for a temporary purpose if you're doing it for the rest of your life, as it were. I know what you mean.
But if somebody helped out in a different shop, there's quite a common example I've seen from the revenue is where a shop manager helps out while another shop manager is recruited for down the road. And so they pop in a day a week or something to check everything's going okay. That's very clearly until the new shop manager arrives, and so would be okay.
That's for a temporary purpose.
If it was for ongoing, then that's when you've got a problem. Okay. Our second question comes from the FN Accounting, and it's a wonderful question. It is a situation we would all like to be in every day of our lives. A client, which is a company with a director shareholder, is making handsome profit, but does not need, the director shareholder does not need to withdraw the funds, and therefore there is a large surplus left in the accounts. The question is there an innovative way of distributing this fund to minimise the personal tax? I mean, the obvious answer is low salary, high dividend, away we go. But what else could he do?
Yes, the obvious answer is look at drawing those distributable reserves in the most tax efficient way. It'll depend on the taxpayer's other income. Does the questioner state how much? No, they just say handsome profit, doesn't need to withdraw funds. What, however, one or two commentators then move on to is the suggestion of leaving the profit in the company and using it as a personal investment company. And in particular, the poster DJKL, whoever DJKL is, says do not distribute, use company as an investment vehicle, give up the idea of ever withdrawing the capital and say invest long term via the company in dividend paying quoted company shares. So use it as that personal investment company, which can be very tax efficient. Of course, you've still got the issue of taking the money out of the company, and that will then be more tax efficient by way of dividends. We know all about the rules on loans to participators and all the rest of it. He goes on to say it's not for everyone, but it's preferable as long as it's expected you'll never have the need for the capital. Of course, if you need the capital, then turning it into an investment company is going to prevent any possibility of capital gains tax entrepreneurs relief, so we'd need to be careful there. Even my own small part-time practice, not me, this is the commentator, has this issue. With the reduction in the dividend allowance, of course, we can now only get £2,000 a year tax-free dividends. It'll be accumulating cash. They're only distributing £4,000 a year, they say. In the future, they're not prepared to suffer 32.5%. Of course, for top rate, it's 38.1%. But yeah.
So one suggestion that was put to me by a friend was that they had money left over in their company. They were going to buy a house within the company, rent it out, and they were utterly certain, absolutely no doubt in their mind, that they would then be able to sell their company one day, qualify for 10% tax through entrepreneurs relief. The problem is that as soon as you move away from being a trading company, this is the problem that you're going to face.
Exactly.
What about pensions? The other possibility is to pay a pension to that person. We don't have to take the money in terms of salary and dividend.
Subject to the restrictions, the annual allowance, having the relevant earnings, then yes, pension contributions remain very tax efficient.
And would result in a corporation tax deduction as well, of course. So there are various options, I think, is the answer to that particular poster. As ever, do post your questions on Any Answers on AccountingWEB, and perhaps next month Tim and I will have a look at one of the questions you've posted. Until then, bye-bye.